Welcome to M&A Access, the official podcast for the Alliance of M&A Advisors. My name is Gina Galusha, and today I'm here with Bill Wiersema, and he is one of our SEMA instructors. We're at summer conference in Chicago, and you're a Chicagoan. Is that how you say it? Chicagoan?
Yes, absolutely, a local.
There you go. We'll say he's local. So he stopped by to do the podcast. Welcome. We're glad you're here.
Well, I'm very glad to be here, and thank you so much for that introduction. And I also wanted to thank all the listeners who are hearing this today.
They're good people, from what I understand.
I know they are.
So today we're going to talk a little bit about your background and then Q of E and the Q of E process, the highs and lows and the tricky bits. Sound good?
That sounds great.
Let's do it. So tell us about your background.
So I'm an audit principal with an accounting firm called Miller Cooper & Company. We're a 650-person accounting firm that's headquartered in Chicago. We've been around since 1919, so we're very proud to have celebrated our 100th anniversary about 7 years ago. And I'm actually the relationship principal on a client that's been with us the entire time for 107 years.
Whoa, no kidding.
Oh, yeah. So
that's amazing.
So very proud of that, and it's a nice legacy for the firm. But as I said, I'm an audit principal, but I have a specialty in transaction advisory. So I work with both buyers and sellers, helping them through transaction, predominantly through Q of E, which is, of course, our subject today, in due diligence. In addition to all of that, though, I did want to say that this is my favorite topic, of course, to talk about, and I'm always honored to speak for the M&A, and I'm very excited to be here presenting.
Oh, good. Okay, yes. So when we're talking due diligence, it's primarily financial due diligence, right?
Exactly, yes.
Okay. So what part, you said you work with both sellers and buyers. When do you suggest folks start to think about Q of E or financial due diligence in the deal process?
I'd say ASAP, even before they start the process, because fundamentally what led me to want to specialize in this area is that throughout my career I've sought to add value for my clients, and I found that M&A had a lot of opportunities to do that. So for example, with buyers, they want to make sure that they're not overpaying for deals, and also they want to stay out of bad deals. They don't want to buy high and sell low. Mm-hmm. That's the idea with them. Whereas with sellers, what you find is a lot of times this is their first time through a process, and you want to make sure that they get the right price, that they're prepared and not blindsided. So those are the ideas. So in the process, I generally will either save or add for clients 6 to 8 figures per transaction.
Oh, wow.
And so I enjoy it very much. It's a very tangible outcome and value add that I can provide.
That's impressive.
Thank you.
So when you are working with a client early on, where do you start?
You know, it depends. Again, whether it's a buy side or a sell side. With a buy side, I would start with looking for red flags. In other words, let's look at the transaction. Let's see what it tells us. And I'd also consider, of course, the buyer's objectives. And there are various types of buyers. Not everyone is a financial buyer. A financial buyer is focused on EBITDA. But strategic buyers may be focused on different things. For example, there may be a particular synergy that they're looking to obtain. I was involved in helping a client sell an unsolicited bidder who was a strategic, who was basically looking for access to one of their key customers for a very minor division of their company. So that was what that strategic was looking for. And then similarly, I've worked with venture capital, which is kind of a little bit more further along type of companies than you see on Shark Tank, what venture capital is interested in. But typically they have a growing top line, but no bottom line. They may well be negative cash flow. So with them, there's, again, a different emphasis than you would see on a strictly financial buyer or private equity that are looking for EBITDA. But generally it starts with looking at red flags, looking at the financial statements, and collaboratively assessing where risks are. Because it is, in the end, an 80-20 type of rule that applies to due diligence. In order to 100% comprehensively look at everything, obviously it would be cost prohibitive. So you're looking for the biggest bang for the buck. You're looking for the largest return on the amount of budget that the particular buyer has. So that's how I would start with the buy side. Sell side's a little different, of course, because there you're looking to help them be prepared and not blindsided. You want to go through all of their information kind of as a dress rehearsal for what they're going to encounter with buyers and help them prepare information that then buyers can work off of. And a lot of times I'm asked, well, gee, okay, so you found an issue, Bill. It's sell-side due diligence. What do you do about it? In other words, is this something that we should try to sweep under the rug, or what should we do? And in the end, what I would advise sellers as I go through their information is, to the degree that there are findings, that we address them, because the best time to address them is before a buyer raises them. The worst thing you want to do is wait for a buyer to raise an issue first, because their due diligence team is going to interpret it in the most conservative way possible. They're not going to see the other side of the issue, whereas if you address it in advance and make it transparent, all of a sudden it may well become a non-issue for the buyer, and that is really the value of preparing. And I'm really itching to give an example of this, because it also talks about why sell-side due diligence is so important. I was involved with a company, or I became subsequently involved with a company, I should say, that was audited. You would think they did all the right things in terms of preparing for exit. They had audits done every year. They had GAAP accounting, so to speak. They were compliant. But what happened when the buy-side due diligence team came in is they uncovered that during the trailing 12-month period that they were looking at, that what had happened was the inventory reserve went down by several $100,000. And to a buy-side due diligence firm, what that means is that cost of goods sold was less than it otherwise would have been, because this excess credit, and if you know accounting debits and credits, the credit went against cost of goods sold, and inventory grew due to that reduction. And they made a big deal out of it. They said that this was automatically a deduction from EBITDA. Now, you're thinking only a few $100,000, right? I mean, it doesn't seem to mean that much. However, when you apply the multiple, of course, it was in the millions. It was a real number, and it meant something. It was more than pocket change. So what the seller did, unfortunately, was they reacted badly. They were completely blindsided by the issue. They thought the buyer was trying to chisel, trying to pull a fast one, do the bad thing, and they exited from the deal. And the difficulty that happens in that case is that, of course, it wastes everyone's time and money, but most of all, the seller doesn't accomplish their objective of selling the business. So what happened subsequent to that circumstance was I was brought in to perform a sell-side due diligence engagement for this company. And I dug into that issue because everyone knew that that's what blew up the deal. And what I was able to find was that I could account for that reduction reserve through negative margin sales, through disposals of inventory, and also through charitable donations of inventory. And once I documented that in my report, it became a complete non-issue for the next buyer. So again, that's the type of value that type of endeavor can bring to sellers. It can make the difference between exiting from a deal and having a deal close successfully and cheerfully. And so what I'm finding these days, one of the big changes I'm seeing is that buyers are expecting sellers to more and more to be prepared, but sellers, for their part, are more and more undergoing sell-side due diligence, and a lot of times it's because their broker requires it. Their investment banker says, I'm not going to take you to market unless you have this work done. And everyone acknowledges that how significant it is, because in the past, people would be unprepared, deals would blow up, or either that, or buyers would maybe not even want to invest the time in looking at a seller's financial statements if they perceived that it would take too much work in order to piece together what was actually there, what they were actually buying. So that was a long answer. Apologize for that, but I wanted to cover it.
I love specific examples because it really makes it real and applicable. Mm-hmm. So thank you for that. Sure. Appreciate it. When you let a seller know, hey, this needs to be addressed, let's talk about it, I can see how that, instead of being afraid or upset, just tackling it. How often when you do Q of E do you tell them you're not ready to go to market?
That could and should have happened. Actually, I'm going to give you an example on that, too, since you like examples. I would love to give them. And believe it or not, every example that I'm giving today may seem strange, but it's not fiction. You can't make this stuff up. This is stuff that I've lived through. So here's an example where a CPA probably should have done a lot more for their client. It was a company that was founded by a brilliant engineer, actually had one of the original domain names on the internet.
Oh, wow.
So that's how far back it went. And this engineer was so brilliant that he custom wrote all of his software. It was for CRM, it was for ERP. Everything he needed was at his fingertips and custom written. So very, very sophisticated, very high tech, so to speak, for his time, and developed this over a period of years. But a little known fact was that his CPA came in once a month, they did this for 30 years, and took the information from his system and downloaded it into QuickBooks, I believe is what they were using. And the problem was that the CPA wound up having to plug a lot of numbers, and plug means force numbers. In other words, to make accounts receivable equal what the owner's record said, he'd have to plug the number. Similarly with inventory. And the underlying reason was that as brilliant as the engineer was, he didn't create an accounting system that was based on double entry bookkeeping. He didn't quite grasp that. Didn't really interest him. I guess he had higher level things to think about than thinking about debits and credits. So that in the end, the financial statements that no one looked at, that this accountant produced and became part of the financials, part of the tax returns at the end of the year, were so wildly fluctuating, like a roller coaster from month to month. You would see huge negative margins, 100% negative and 100% positive the next month, that when I was asked by my buyer, I was going in on a buy-side due diligence, whether I could tell them what the trailing 12 EBITDA was for this company, I had to answer very honestly, no. Couldn't tell it from the records we were given, and unfortunately it was to a point where it would almost be recreating records from scratch to be able to make sense of it. So the moral of this story is, I guess, a couple-fold. One is that a lot of times people will tell you, for example, investment bankers, that they prefer an independent firm do the quality of earnings report. Because imagine if the CPA who had been doing the monthly financials did the quality of earnings report. Everything would be fine. And they would go ahead and present it because this is what he's been doing for 30 years. So very important to have a independent firm involved. But in addition, it also underscores, unfortunately, what became a deal failure for this brilliant engineer. And he didn't deserve it. He had a good company, but it was just impossible to determine based on the records how the company actually did. So that was the second issue from that story.
Right. Nice. What would you say are primary causes for, let's say, a failing score on a Q of E?
The first example, I'll give two examples, but the first one that I'll give goes back to what the current issues are, why we're talking about top issues today. A lot of it has to do with the current environment. There's a lot of uncertainty. As we all know, there have been tariffs, there's a war in the Middle East, there's potentially rising interest rates and inflation, and all of this has an impact on deals. So sometimes it's completely beyond the party's control that a deal fails. So an example that I encountered about a year ago, a little over a year ago now, when the tariffs first came out, is a nice manufacturing company that had a subsidiary in China that was doing manufacturing for them. And all of a sudden these rounds of tariffs start hitting, and when the first round hit, they were already in the 11th hour on their deal, about to close, and because of it, though, they were forced to make a 10% price concession, and they were willing to go ahead with the deal at that point. But then within a couple weeks, there was another round of tariffs and another increase. I think in China it wound up being 140% tariff for a while. And what happened is the deal blew up completely. The buyer completely exited, they got spooked, and the deal was done. So that tells you, in a way, how deals can fail through no one's fault particularly. Another way, though, that deals fail is not through any particular issue, and a lot of times that's a question, gee, will this cause a deal to fail? And in my experience, a particular issue doesn't cause that, because to the degree that the parties are willing to collaborate and they maintain trust of each other, they're going to be able to work it out one way or the other. They're going to be able to negotiate it. They're going to be able to move forward. But there was one circumstance that am very familiar with where the seller actually was offered a nice number for his company, and after due diligence, the buyer came back with a 30% lower price and said the reason is that it would be very costly to replace him and his family's role in the executive team. And the seller was just so completely upset. And again, it was because, like in that inventory reserve example, he lost confidence. He lost trust. He thought the buyer was a chiseler and therefore exited the deal.
Mm-hmm. Mm-hmm. Yeah, I can see how, particularly in the topic of Q of E, that it can be a strong area of vulnerability in that important trust to get a deal closed. When you have on the buy side, kind of like what we were just talking about, you see a sim and you're like, this looks great, and you do a little digging, and the Q of E is different. What does the advisory role on your side look like in them maybe restructuring their offer? Do you ever kind of speak into that, or do you just provide the Q of E and let them make their own decisions?
Normally buyers, particularly private equity, work off of models that they consider proprietary when they value the deal.
Fair, yes.
So definitely that wouldn't be something that they would normally share.
Mm-hmm.
However, I think in terms of understanding issues and their potential impact, definitely the due diligence plays a role. And ultimately, as you know, the primary deliverable of an EBITDA report is adjusted EBITDA. In the middle market, that's the benchmark for value. Everybody talks EBITDA, and there are statistical publications like DealStats that are based on what multiples companies trade at based on size and industry. So definitely a very telling amount, but as far as specifics of how they would modify their offer, not so much. As I said, though, making them aware of the issues and making it solid to them is probably my most important role in renegotiating. Sometimes, though, I do get involved in areas, for example, say working capital and debt-like items, going in and trying to negotiate those areas. And that, unfortunately, is a neglected area. What you can find a lot of times is that that's a hidden price in deals for sellers, unfortunately, that there may be a problem created by that distinction between working capital and debt-like items. What happens is when a particular liability is treated as working capital, it's built into a working capital target, and therefore it's only the change in that liability that impacts the closing. Because if you remember, cash-free, debt-free, it's also adjusted for working capital. So debt comes out, but working capital adjustment based on the variance from a target comes out. But when that liability becomes indebtedness and is treated that way, all of a sudden it's dollar for dollar deducted from the sales price. So a lot of times what I find is that buyers might get aggressive with that. And it's all definitional in the end. And therefore, when I lecture to classes, MBA programs, for example, the biggest advice that I give to them, and this is something that I find that they remember for years to come, is to listen to their mom. Okay, I say, what would your mom say about all of this when you're talking about how definitionally driven indebtedness is, that there really isn't any source that you can look at that says definitively that this particular item is debt or not, other than bank debt, let's say. And what your mom would say, the advice that you should have listened to with your mom is watch your language. In other words, you have to be sure that your agreement reflects what you intend, what you want it to say. And a lot of times disputes arise because of apples to oranges interpretations. And I get involved as an expert witness in deals. Post-closing, I'll be brought in, and I've testified before the New York Supreme Court and Federal Bankruptcy Court and a number of other areas as an expert witness, and that gives me particular insight into how those disputes arise. And usually it's due to imprecision in definitions, things like indebtedness, or if you even talk about generally accepted accounting principles, that's another area that's subject to all sorts of gradations and interpretations. And the difficulty that can arise is if a seller agrees to GAAP, or generally accepted accounting principles, a buyer may come in and impose their own interpretation. I'll give one more example, and then I'll let you ask another question. I apologize. And I know you like examples, but this is a steel distributor, so you can imagine this isn't inventory that goes bad or spoils. And what happened is this company was acquired by a much larger company who had its own policy relative to what's called an inventory reserve. In other words, it's a contra account to inventory to reflect a reduced value, a value below cost. That's what this buyer had. So what happened was that the seller agreed to GAAP, not knowing any better, and always thinking that, gee, if something's bad or I can't sell it, I'll throw it away or I'll scrap it. That's what I'll do with it. But the buyer came in with a policy that said anything in excess of 6 months usage is bad. And by the time they claimed that post-closing against working capital, a lot of that inventory is already sold. But this was based on a theory. This was based on their interpretation of GAAP, and they actually used it for their company, so they felt it was legitimate, and it led to a big dispute. So it's that type of thing, when you're thinking about apples and oranges, that a lot of times people aren't fully aware of. And I find that this is value that I can add, for example, with legal counsel, to go through, hey, I've been through this, I've been through disputes, I see how they arise, it's apples to oranges. And ultimately, when it comes down to negotiating and you bring up that all you're really looking for is a fair and known mechanism for resolving the true-up, it's very hard for people to argue with that. And so usually it leads to a result where you truly do have people riding off into the sunset post-closing rather than in court disputing apples and oranges issues relative to working capital or earnouts or other post-closing true-ups.
So with financial due diligence, what is the difference in the approach there versus when you're looking at quality of earnings? What are you digging into? I'm assuming like when you start with financial due diligence, you're first thinking of like what is the outcome that the buyer is looking for, right? Mm-hmm. And then that's how you approach what you're digging into, that 80-20 rule?
Right. Yeah, it starts with the approach, what they're looking for, what the particular risks of the deal are, and then constructing a work plan around that. So from there, since it's targeted to the issues that we've raised, it's very likely that we're going to find the biggest issues that are out there. And I characterize due diligence as probing. You're kind of putting your fingers against a wall and seeing what caves in. Because there's no way that you can look at 100%. You have to probe. You have to feel it out, and if something caves in, well, all of a sudden, that's something that you're going to investigate and try to put a number around, try to get additional information, and sometimes it entails going back to the seller and saying, hey, we need more information, maybe you need to involve your accounting firm. Sometimes it may be something that we can estimate, but unfortunately, as buyers, representatives, a lot of times we are very conservative in what we estimate because we don't want to give them a misleadingly low number. And the biggest issue, though, in diligence when you're dealing with buyers is to realize that really at the point of pre-transaction, the seller really controls all the records, holds all the cards with respect to the information. And so understandably, buyers are very conservative. And so you have to be aware of that and be respectful of that because, after all, that money may come from even friends and family. It may be private equity money, putting their career at risk. I mean, there's a lot of things, a lot of risks that people take when they're buying businesses, and due diligence is seen a lot of times as deal insurance. In other words, it's insurance that they're making the right decisions, decision support. So that's where the diligence would lead, and usually that's the process, what I just described.
Okay. What do you think are probably the biggest areas where you typically find that the wall is caving in?
Wow. Well, I'd say the biggest areas would be... Like
most common.
Yeah, I'd say the most common areas would be areas that the seller didn't prepare for or is blindsided by. And again, that gets back to the idea of the seminar being about top quality of earnings issues because, for example, let me give a couple examples. In generally accepted accounting principles, there was the big three of new accounting standards, which included revenue recognition, credit losses, and leases. And a lot of middle market companies haven't fully grappled with that yet, particularly if they don't have external reporting requirements. And if they are just suiting their records to their own purposes. And let me give you an example of that. I think revenue recognition is a really big area. So let me give you an example. I went in on the buy side of a custom kitchen remodeler where the owner felt that in order to motivate the sales staff, that they would record revenue at the point the customer signed the order. And that was before the work had started, even before they bought the material. So their accounting firm said, we're going to create this algorithm for you. We're going to back out X number of weeks of sales, and that should make everything okay for you. But what I found on the first day of due diligence and actually looking hard at the numbers was that they had overstated EBITDA and revenue and accounts receivable by 7 figures. So that was enough to stop the deal in its tracks right there. And subsequently, the accounting firm scrambled to reissue reviewed financial statements, even amend tax returns, in order to overcome and restate the entire problem. So ultimately, 4 or 5 months later, we were able to close the deal, but it was on different terms. Mm-hmm. And again, I was very happy that it prevented my seller from getting blindsided. And revenue recognition, though, comes up in a lot of different contexts. Another context would be, let's say, a SaaS company that receives annual subscription revenue in advance. The problem with that is, again, if you apply the revenue recognition standards, that revenue needs to be deferred. And when you record that deferred revenue, sometimes what you find is the company's actually insolvent because the revenue that had come in has already been paid out as distributions to owners. And so effectively, it's become a Ponzi scheme, I hate to say it, where they are taking current subscriptions for the next year and applying it to fulfill the old the subscriptions where they've already paid out the money. So very significant. I'd say revenue recognition is an issue that comes up quite a bit. As far as the tax side, a lot of attorneys believe that state and local tax is the issue in deals. And it originated, for the most part, with the landmark case that the Supreme Court handed down called Wayfair. It was the Wayfair case. It was back in June of 2018. Now, that seems like a long time ago, but a lot of companies still haven't dealt with it. What the Wayfair case did is take what used to be a physical presence standard, which was under the prior Quill decision from the 1990s, and change it, completely change it to what is now called economic nexus. And I know that sounds kind of academic and kind of esoteric, but it's not at all. All it means is that if you sell to my state, you need to register, withhold, and remit sales tax in my state. So it means all of a sudden that companies that used to, let's say Illinois, since we're standing in Illinois right now, let's say I'm a repair parts distributor in Illinois. It used to be that if I sold to customers under a manufacturing exemption, it meant that I didn't have to pay sales tax on those sales, and I didn't have to worry about other states. It didn't matter how much I shipped there. But under the new rule, what happens is you now have to worry about all the other taxing jurisdictions around. So, for example, 25% of states do not have a manufacturing use exemption. And what the court agreed to that was proposed in the case was a threshold of $100,000 in sales over the trailing 12 months or 200 transactions. So all of a sudden, this Illinois repair parts distributor, if they were to make a $100,000 sale to a company in Hawaii, is responsible to register, withhold, and remit sales tax, otherwise suffer the wrath of the state of Hawaii. So it's become an entirely different game. Not only that, though, it's not just states, it's not just the counties in the states, it's not just the municipalities. All told, there are about 10,000 autonomous taxing jurisdictions in the United States, and each one of them, of course, is coming up with their own rules that optimize their own scenario, and a lot of times out-of-jurisdiction companies are easy targets because they're not part of the voting constituency, frankly. And there may be doubling up. There may be of people double taxing things from different jurisdictions. There might be a complete lack of coordination. And just to keep up with this is a mammoth task. But even more important than that is the fact that even in asset deals, potentially under state case law, there can be successor liability. So that means that it can follow assets, this whole liability. And not only that, But economic nexus can apply to other non-income tax areas, things like taxes on capital or taxes on revenue or property only. Those areas can be subject to this economic nexus rule. So, for example, the state of Oregon or the state of Texas have those kinds of taxes where potentially economic nexus, this doctrine, can be applied. So it's led to potentially a Pandora's box of issues being opened up for state and local tax. And as I mentioned at the outset of the story, it's attorneys a lot of times that believe this is the big issue in deals. Mm-hmm. So something to definitely be aware of.
For sure. Okay, so a couple closing questions for you. If a seller is a year to a year and a half out from a sale, or from going to market, what should they be doing now?
And I'd say if they want to involve a pre-due diligence, sell-side due diligence, I think that would certainly be a good approach. But what they can try to do internally is try to transaction ready their books, get their add-backs organized and supported, and make sure that they understand working capital and debt-like items, because these are the things that ultimately we would help them document in the sell-side quality of earnings report. So it's about getting their books together from a financial perspective.
Yep. I think, you talked a lot in your examples about how the process that they use for their accounting, for their business, worked great in a lot of ways for their purposes, but it doesn't necessarily work great for the way the seller is going to be thinking about that financial health, right?
Exactly. And you find that there's a big difference between running a profitable business and having transaction-ready financials. A lot of times owners in the middle market are so involved in their business that they don't need reporting systems. They have their hands on the pulse of everything, their fingers on the pulse, I should say. So therefore, they don't feel a need for particular reporting or particular monitoring. And so when third parties enter the picture with different demands, of course, they can be blindsided by the whole thing. Now, it's a little different, though, if they've been used to having to report to a lender, for example, or being audited. But as I mentioned earlier, that is no guarantee. So, for example, that custom kitchen remodeler was getting reviewed financial statements. So a lot of times it does depend on having people internally that understand what they're doing, how they're supposed to account for transactions. In the case of the custom kitchen remodeler, it was actually all family, and none of them were really accountants. So they were relying on the accounting firm as more or less a black box, which could be a big mistake. And I found that a lot, for example, with companies that are contractors, where the accounting firm comes in at the end of the year, and the problem is that they may not fully understand. I actually uncovered a situation where materials had been double counted, both as stock inventory and as charged to jobs, and when it was charged to jobs, added margin. So it resulted in a huge uptick to EBITDA, which, again, buy-side diligence was needed to uncover.
Wow. So many fun and interesting, would you say, like Sherlock Holmes style accounting?
Oh, that goes on all the time. I guess it's just kind of in the eyes of the beholder, what's fun.
Right.
And before I forget, I should encourage all the listeners and viewers to link with me on LinkedIn. I'd love to have you connect, because what I do there is I talk about current issues, but I also bring up a lot of fun things like you're talking about. So that keeps it very interesting. And of course, I'm also going to be posting on this podcast, so I'd love to have all your listeners join.
Absolutely. No, that would be great. Connect with Bill. And thank you so much for joining us today.
Yeah, and just in closing, let me tell you what I believe, though, my role is in financial due diligence, just to make clear. And I consider my role, whether I'm on the buy side or sell side, to find issues, fix them, and help everyone succeed. That's what I consider my role to be, more than everything else.
Yeah, that's the goal. Not fix them to just reveal, or find them to just reveal, but to find them to fix them.
Right, and the idea of due diligence is never to kill a deal. It's to support better decisions.
Right, absolutely. Everybody who's on the deal team should be supporting the deal. right? To get it done and get it done right.
Absolutely.
For sure. Awesome. Well, glad you could join us today.
Yeah,
and
thank you
share
so
your
much, Gene.
stories
This has
and your
been
insights.
wonderful. Yeah, we ought to do this more often.
Yeah, we'd love
I really
that.
enjoyed it. I really
Good.
enjoyed it today.
Glad
Thank you so
could
much.
join. Awesome. And thank you for joining us. We'll see you next time. These kinds of conversations are happening all the time. We'd love for you to join in, whether it's through our monthly webinars, our biannual conferences, or our SEMA certification, and then we have our chapter events across the nation all year round. You can find out more at amaaonline.com. Until then, see you next time.